Welcome to the accounting class. In this session we shall take another look at inventory. Inventory is not simply about counting items, whether they are finished goods or assembly parts. What else is inventory about? Let's consider what happens when we go out and buy a new automobile. Our chosen vehicle has a unique identification number, so that the seller knows exactly which vehicle has been sold, the buyer knows exactly which vehicle has been purchased, and the manufacturer too can identify each vehicle. Automobiles are expensive and are also tracked for other reasons, including tax. Not all sales can be tracked in this way. Think about what happens when you purchase a lawnmower and then resell it. You issue a receipt on the sale, but it is not likely to record a unique identification number, even though there are many items that do have unique serial numbers. Suppose that there are now 3 lawnmowers in the store and you are going to sell those 3 lawnmowers. You bought the first for $90, you bought the second for $100, you bought the third for $110. 2 of these lawnmowers are then sold. They sell for $200 each, so we have revenue of $400. But which lawnmower is left, and what is the value to use for inventory? The answer that we choose will affect our answer to this question. The various methods that you can choose are called cost flow assumptions, and there are a number of methods that are acceptable in the United States. Let's look at those accepted methods. FIFO, LIFO, AVCO. What do these mean? FIFO stands for first in, first out. The cost flow assumption is that the first goods that were bought are also the first to be sold. How does this affect the mowers that were sold? If the 2 oldest have been sold, then the one bought most recently is the one that is left. That means the one that is left is valued at $110. So that $110 is the figure that we shall use for inventory. Suppose we use the assumption of last in, first out. This assumes the last goods purchased are the first to be sold. You should note that whilst this is an accepted method to use in the United States, it cannot be used by companies in Europe. Let us apply LIFO to the sale of the mowers. The mower that is left is considered to be the first one that was bought. That mower cost $90. That's the value that we shall use for inventory. The last method uses the average cost to determine the value of inventory. In this method, we calculate the average cost of the mowers. The mowers cost $90, $100 and $110. That means a total of $300 for 3 mowers, so the average cost is $100. So the one that is left must be valued at $100, and that is the value to be used for inventory. Now each of these assumptions can have different effects. The method that you choose will affect the income statement, the balance sheet, and the amount of tax that is paid. To show this, we're going to consider the lawnmower example a little further. We're going to assume that the operating expenses we need to apply are $10 and that the tax is a rate of 20%. And these assumptions are going to apply regardless of the method that we choose for inventory. First, look at using FIFO. Our ending inventory was $110. The 3 mowers cost $300, so the cost of goods sold will be $300 less $110, that is $190. The revenue from sales was $400, so the gross profit is calculated by sales less cost of goods sold. $400 less $190 equals $210. Subtract another $10 for operating expenses and we have net income of $200, and tax at 20% will amount to $40. If you're unsure about those calculations, go back and look at the podcasts on the income statement. Now look at what happens if we used LIFO. Our ending inventory is lowered to $90. The cost of goods sold rises to $210. This lowers gross profit to $190 and net income to $180. So the tax to be paid will be 20% of $180. That is $36. Using the average cost gives us yet another set of results. The ending inventory is $100, cost of goods sold $200, gross profit $200 and net income $190. So the tax to be paid is going to be 20% of $190, that is $38. The differences between the methods affect the values used for inventory. Now inventory is an asset, so the balance sheet is affected. The income will differ, and that affects the income statement. In turn, retained earnings will differ, affecting the balance sheet again. And of course, the tax paid differs. Now a business has to select one of the methods, and then it has to use it consistently. Look at the summary of the methods. Now the LIFO method does suggest some advantages. In particular, showing a lower income means that there is less tax to be paid. However, it also lowers the value placed on assets. Remember, US accounting principles allow LIFO. The accounting principles in the United Kingdom and international accounting standards do not accept LIFO for financial reporting. Companies using LIFO are now required to show a further figure. This is the amount that the inventory would increase by if it had used FIFO as the method. There are situations when these methods will still need some further adjustment. What happens if the goods that remain in inventory are actually worth less than you originally paid for them? What value should you then use? The accepted principle here in accounting is to use the lower value of original cost or current market value. Finally, if you are an investor, there is an easy calculation you can do which can provide you with a little more information. The inventory turnover ratio gives a measure of how quickly goods are being sold. It is calculated by dividing the cost of goods sold by the average inventory. This is the end of the second session on inventory. Thank you for listening and watching.